Hello, good day, and welcome to today's lecture in a practical introduction to day trading. In this lecture, we will cover types of market analysis. So in this lecture, we will look at types of orders, types of Forex market analysis, types of Forex charts and how to read them, support and resistance. There are different types of orders. There are market orders and there are limit orders. A market order is an order to buy or sell an asset immediately. This type of order guarantees that the order will be executed. In this order, you buy or sell the asset at the current price. Let me show you an example. Here the market is open. Let's choose an asset. I chose WTI crude. Let's buy at market. We click here, buy. This is the lot size. We can adjust the lot size. The lot size is how much we are risking per trade. I am choosing the smallest possible lot size in this example. Here we buy at market. We click buy. When we buy at the current market price, which is $62.36. If we click this button, we sell at market. How do we get this set up? Right click. How do we create a button here to enter a trade? Right click. We click one click trading and the button appears right here. Or we can click here, order. So we click here, new order, and here we can enter a trade. This is a box where we determine if to buy at market or limit. Here we have market selected. We can buy at market or we can sell at market. When we buy or sell at market, we buy or sell at the current price. However, sometimes the current price is not the price that we desire. We may anticipate the price of the asset may go higher or go lower. So we may desire to buy or sell the asset at a price that is different from the current market price. How do we implement such a trade? We implement a limit order. A limit order, you place an order to buy or to sell at your preferred price. Let me show you an example. So to buy at limit, we right click, buy limit. We bought at limit. To sell at limit, we right click, sell at limit. We sold at limit. So here we bought the asset at $45. We set a limit order to buy at $45.21. This order will not fill unless the price of the asset drops to $45.21. If the price of the asset does not drop to this low level, the order will not be filled. In this limit order, we set the order to sell at $68.51. The order will only be filled if the price of the asset rises to $68.51. If the price of the asset does not rise to this level, the order will not be filled. That is the essence of market and limit orders. Market orders are orders to buy or sell the asset at the current price. Limit orders are orders where you specify the price where you want to buy or sell the asset. Now we will proceed to the different types of market analysis. There are three main types of analysis. The first is technical analysis, the second is fundamental analysis, and the third is top-down analysis. There's often a debate between traders about which type of analysis is better. In fact, some traders say that technical analysis is better than fundamental analysis. In reality, the different types of analysis can help the trader make informed decisions and take winning trades. Technical analysis is a type of analysis where traders study the price of the asset. They study price movement. Retail traders that rely on technical analysis believes that the current price reflects all the information about the asset. Technical analysis focuses on charts, price patterns, indicators, and indices to determine if it is an appropriate time to buy or sell the asset. There is a subset of technical analysis that is called price action analysis. Price action analysis focuses specifically upon price, charts, and chart patterns. Price action analysis does not rely upon indicators and indices. Indicators and indices are ratios. These ratios provide information about the price of the asset and can tell you if to buy or to sell the asset. Fundamental analysis is where we study the economic factors that may be driving the price of the asset. In other words, there are different demand and supply factors which may cause the price of the asset to go up, or they may cause the price of the asset to go down. Fundamental analysis can be applied to Forex, commodities, stocks. It can be applied to any asset. Top-down analysis is the type of analysis where the trader considers how an industry is performing. If an industry is performing well, the trader can assume that the firms operated in the industry should be profitable and should also perform well. For example, in the cement sector, if the cement sector is performing good, then it can be assumed that a national cement company can also perform good. If you run with this assumption, then you can go long, you can buy the shares of the cement company because you can expect the cement company to be profitable and you can expect to earn dividends from the cement company's shares. Technical analysis and fundamental analysis may sound like very technical terms, but in reality, these different types of analysis are not very complex. Technical analysis relies on charts and chart patterns to identify trends. This type of analysis tells you the appropriate moment to buy or to sell an asset. Fundamental analysis involves reading economic data reports and reading news, analyzing the market based on different demand and supply factors. This will help you determine if the price of the asset may go up or go down, and if the market is bullish, meaning that the prices are high and the prices are going up, then you can go long or you can buy the asset. If the fundamental analysis suggests that the market is bearish, meaning that prices are low or prices are going down, then you can go short, which means to sell the asset. Now you may be asking which type of analysis is better. In reality, both types of analysis complement each other. Fundamental analysis can be used to tell you the overall direction of the market. Technical analysis can be used for you to decide the correct entry point to enter a trade. The next thing we want to consider are charts. What are charts? A chart shows the movement of the price of an asset. This is an example. This is a chart. There are different types of charts. There are line charts, there are bar charts, and there are candlestick charts. This is an example of a line chart. We see a line. The line plots the closing price of the asset, and it shows how the closing price of the asset changed over a period of time. This is a line chart. This is a line chart. The line plots the closing price of the asset, and it shows how the asset price changed over a period of time. This is a bar chart. A bar chart also plots the price of the asset, and it shows how the asset price changed over time. However, it provides additional information. Each bar shows the highest price, the lowest price, the open price, and the closing price. So we see here, so this is a bar. This was the highest price, this was the lowest price, this was the open price, and this was the closing price. In this asset, the price closed at a higher level than the opening price. Therefore, this was a bullish bar. This bar would typically be colored green on your platform. The green bars suggest that the price of the asset was increasing over the period of time. In contrast, we can have a red bar. In a red bar, here would be the highest price, here would be the lowest price, this would be the open price, this would be the closing price. Red bars suggest that the price of the asset closed at a lower level than the opening price. When looking at bar charts, although you can see the price of the asset and how the price is changing over a period of time, it is not very attractive to look at. The types of charts traders view the most are candlestick charts. This is a candlestick chart. A candlestick chart is comprised of multiple candles. The candles display the same information as the bars. In this candle, this was the highest price, this was the lowest price, this was the open price, this was the closing price. We see here the body is green. This suggests the price of the asset closed at a higher price than the opening price. Green candles suggest the price of the asset is going up. Red candles suggest the price of the asset is going down. This was the opening price, this was the closing price. This was the highest price, this was the lowest price. This green shaded area is known as the body. This red shaded area is known as the body. The area between the closing price and the highest price in a bullish candle is known as a wick. The area between the opening price and the lowest price of a bullish candle is also known as a wick. The same concept applies to bearish candles. The area between the opening price and the highest price in a bearish candle is known as a wick. The area between the closing price and the lowest price of a bearish candle is also known as a wick. This is a candlestick chart. This shows how the price of the asset changed over a period of time. We can see in this candlestick, this was a bearish candle. This was the opening price. This was the closing price. This was the lowest price. This was the highest price. We can see the price of the asset decline significantly in that short period of time. This was a 1 hour chart. How do I determine it was a 1 hour chart? I go here. Let us look at the platform. This is also a candlestick chart. These are candlesticks. This is a red candlestick. This showed that over a period of time, there was a strong decline in the price of the asset. This is a daily candlestick chart. How do I know this is a daily chart? Well, here, one day is selected. To switch from daily to hourly, I click here, 1 hour. This is a 1 hour chart. I can switch from 1 hour to 4 hours by clicking here. I can change from 4 hours to 30 minutes by clicking here. I can change from 30 minutes to 15 minutes by clicking here. I can change from 15 minutes to 5 minutes by clicking here. I can view the 1 minute chart here. I can view the 1 week chart here. I can view the 1 month chart here. Let's return to the daily chart. This area up here shows different time frames for the candlestick charts. The longer time frames can show the overall direction in the price of the asset. So we see here the price of the asset has been on a continuous rise from April 2020 to the present in April 2021. This is an uptrend. If we switch from the 1 day chart to a shorter time period, let's say we look at the 1 hour chart, this can show us short-term movements in the price of the asset. The longer period charts show the overall direction of the price of the asset. However, the shorter periods show the shorter term movements in the price of the asset. Candlestick charts carry several advantages. They are easy to interpret. They are easy to use. They are very good at indicating trends. And they can highlight if the market is going up or bullish. And this can highlight if the market is going down or becoming bearish. Candlestick charts can also indicate if there's a change in the trend. They can show if there's an upward trend and the trend has changed to a downtrend. They can also show when downtrends change to uptrends. When the trend of an asset changes, it is referred to as a reversal. We can see a reversal right here. There was a downtrend. The price of the asset reached this minimum point, and then there was a change in the overall trend to an uptrend. The price of the asset went down. The price of the asset was bearish. And after May 2020, the price of the asset became bullish. There was an uptrend. Candlestick charts can also be used to highlight possible areas of support and resistance. Now, these terms may sound technical, but they are not very technical. Support and resistance is one of the most widely used concepts in trading. Support is a price level where a downtrend can be expected to pause. Think of support like a price floor. It is a level where the price may have difficulty going below. Let me show you. This was an area of support. The price of the asset was moving sideways. then it reached a minimum point, then it proceeded to go up. How do we know this is an area of support? Well, this was a low. Low points in candlesticks can reveal possible areas of support. Support may not be a specific point. Support may be a range. Here, the support may be between $36.65 and $35.73. This is a possible area of support. How can we identify support? When we see two low points or two lower lows, they suggest possible areas of support. If we receive a third touch of a candlestick wick, it confirms an area is a potential support zone. So we see here 1, 2, 3. 1, 2 suggests this was a possible area of support. The third touch confirmed that this was a potential area of support. Let's look at this diagram. This suggests that this was a potential area of support. This was also a potential area of support. How can we determine this? These were possible low points. We see in this candle, the price of the asset closed at the lowest price. There were 4 touches of the candle right here. 1, 2, 3, 4. This suggests this was a possible area of support. We see a 5th at the 6th touch confirming actual support. So as a rule, 2 touches suggest a possible area of support. However, 3 or more touches actually confirms a low point may be an area of support. We look for lower lows to determine areas of support. This was a lower low. This was a potential area of support. Now, you may be asking, can this be an area of support? No, this is not an area of support. Why? Because this was a higher low. So we see here, this low was almost equivalent to this low. This was a higher low. This was a higher low. This low was lower than this low. However, this was the lowest low. So this was an area of support. This is the area where the price of the asset may have difficulty going below. This is not the lowest low. So this was not a potential area of support. This was not the lowest low. Hence the reason this was not support. The opposite of support is resistance. Resistance is a price level where the price of the asset may have difficulty in going above. Resistance is analogous to a price ceiling. It is a level where the price may have difficulty in going above. It suggests a potential turning point. The price of the asset goes up, it reaches a high point and then goes down. The price of the asset goes up, it reaches a maximum or it reaches a high point and then goes down. Just like support, support can be determined by lower lows. Resistance can be determined by higher highs. How do we identify an area of resistance? This is a potential area of resistance, this zone. This zone is a potential area of resistance. How do we know this is a potential area of resistance? This is a higher high. This high was higher than this high. There were 3 touches. 1, 2, 3. Recall 3 touches confirm an area could be support. 3 touches can also confirm an area can be resistance. Support can become resistance and resistance can become support. This area was a potential area of resistance. We see here resistance also held. It is also possible for the price of the asset to break resistance. We see the price of the asset went through resistance. This is called breaking resistance. When the price of the asset breaks resistance, resistance can now act as support. This happened right here. the price of the asset broke resistance and then bounced off the area that was previously resistance. Resistance is now acting as support. The price of the asset went up, broke resistance, bounced off resistance, resistance acts as support, and then the price of the asset goes up. Here we see the previous resistance is also acting as support. How can we determine this? The price of the asset is bouncing off this level of structure. The price of the asset is bouncing off the previous resistance. The previous resistance is now acting as support. The price of the asset also bounced off the previous resistance right here. This area is now acting as support. So the price of the asset is bouncing off support. Here, around the end of March, this price level was acting as resistance. Around the 16th of April, this price level was acting as support. Around the 16th of July, this price level was acting as support. Around the 14th of August, this price level was acting as support. Just remember, resistance and support are price levels where the price of the asset may experience difficulty in going above or going below. This is support. This is a price level where the price of the asset may experience difficulty in going below. This is resistance. This is a price level where the price of the asset may experience difficulty in going above. However, from time to time, the price of the asset may break resistance or break support. This is called a breakout. We see on the diagram here, the price of the asset broke resistance. A breakout occurred. Usually breakouts occur when the price of the asset is responding to news. Some information may be released regarding the demand and supply fundamentals of the asset, and it may cause the price of the asset to react strongly to these fundamentals. A breakout occurred here. The price of the asset went down and broke the previous area of support. A breakout occurred here. The price of the asset went down and broke a previous area of support. This support was a zone. This was a zone. This was support. A breakout also occurred here. The price of the asset went down and broke a previous area of support. Then the price of the asset went up. It fluctuated at this area, which was acting as resistance. Then the price of the asset went up. A breakout occurred here. The price of the asset broke resistance. It bounced off resistance. Well, it consolidated around this area, which is now acting as support. It broke support. It bounced off the previous area that was acting as support, which is now acting as resistance. It bounced off resistance. The price of the asset went down. It bounced off support. It bounced off support. It broke support. It is bouncing off resistance. It broke resistance. The price of the asset went up. It came back down and broke support. The price of the asset keeps bouncing off support. It went up. It bounced off resistance and then went down. It broke support right here. So the price of the asset can break support. The price of the asset can break resistance. When the price of the asset breaks support or resistance, it is referred to as a breakout. So that will bring me to the end of this lecture. Thank you for listening and stay tuned for more.